Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bloomberg Intelligence Radio. All right, let's get back to those consumer confidence numbers because we continue to see the soft data disappointing, yet we do not see that within the hard data yet. Consumer confidence falling to a 2-year low. For more on this, we are joined by Stephanie Guichard, senior economist at the Conference Board. She joins us. Stephanie, walk us through this 2-year low. What was behind it?
So the index fell 7.2 points to 92.9. And as you said, this was the lowest since August 2021. What's important is that now this was the fourth consecutive decline. And now the index is below that range in which it has been hovering for the past 2 years. So it's clearly a weak reading. What has been driving the decline is especially the expectation component of our index, where we see consumers negative about the future of the labor market, future labor conditions, and importantly, getting more and more worried about future income.
So, Stephanie, it seems like I would think one of the key issues here would be job security, and it seems like the labor market's still pretty strong here. But is this just investors kind of taking in the day-to-day news flow and kind of putting that into a confidence kind of expectation?
No, so for the current situation of the labor market, I mean, consumers agree that the labor market is still relatively strong, but looking into the next 6 months, they are getting worried. They are getting worried about the labor market in general. And what's interesting in our survey is that they're also getting worried about their income, which means that potentially they are getting worried about losing their jobs in the next 6 months.
Interesting that it's the labor part, not the inflation and rising prices part. Where did that play into this?
So we don't ask, especially, I mean, in our index, we don't cover inflation directly. However, I mean, we know, and it has been the case for the past 2 years, consumers are not very happy about the level of prices and about the fact that inflation has stopped slowing. So that's key. I mean, this is clearly playing into consumers' mood, but it's not captured fully in our index because we focus on labor market, business condition, and future income.
So I'm looking at the Conference Board. The expectations number came in at 65.2 versus 74.8 last period. Give us a sense. Is that an order of magnitude? Is that concerning?
It is. I mean, we need to see whether this is getting confirmed next month because, as you know, this index is going up and down on a month-to-month basis. But this is the lowest reading for the past 12 years as far as expectations are concerned.
Oof, all right.
One more question as well. Do you do this survey? Is there any distinction between those that identify as independents, Democrats, or Republicans, or is it across the board?
So the survey is across the board.
Meaning that the respondents identify across all of those three bases. So is that what you mean?
So so the survey, the consumers we survey are across the board. We have, the different political groups covered. This is a representative sample of the U.S. population.
All right, Stephanie, really appreciate it. Thank you so very much. Stephanie Guichard joining us from the Consumer Conference Board. She is a senior economist over there. After that drops to a 2-year low. But again, we got to wait to see it in the hard data for us for things to then affect sort of the real economy as well as the equity market and bond market, et cetera.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We had some home building news out today. New home sales came in kind of just a smidge below expectations, 676,000 versus 680,000. We also had KB Homes report some earnings today that were a little disappointing to the street. The stock is down 5%. Let's check in with Drew Redding. He covers all the home builders for Bloomberg Intelligence. Drew, let's start with the new home sales number, 676,000. It's, again, kind of just a smidge below expectations, but a little better than last month. what's the industry look like? What's the market look like these days?
Yeah, so we're up about 2%, give or take, month over month and year over year. We've kind of been bumping along this mid 600,000 annualized pace since mid 2023. So demand isn't necessarily bad, but we're not seeing that lift that we had hoped coming into the year. So overall, the start to spring has been very soft, as you would expect. Affordability is still the biggest challenge out there in the market. Home prices are up 50%. Mortgage rates have come down, but they're still in the high 6% range. And what's interesting now that we're starting to hear more and more, and kind of corroborated by some of the data this morning, is that declining consumer confidence is becoming more of an issue for housing. We heard it from a number of builders. We heard it from KB Home last night, and it's, consumers are more concerned about the direction and growth in the economy, perhaps more concerned that their job isn't secure. So I think that caution is also contributing to the softness we're seeing in the market.
So that's so interesting because we talk a lot about the sentiment data and how that has to translate into the hard data. And and one thinks about that more in terms of like retail sales or GDP, but your hypothesis from the read through we're getting from the actual home builders is that that's actually translating into putting the pause button now.
Yeah, I think you have consumers out there who are saying maybe now's not the best time to make such an important and large decision. We've also heard it from the home improvement retailers. So people in the repair and remodeling market are delaying large ticket discretionary projects. A lot of it has to do with the fact that coming into the year, consumers were expecting rates to come down. They come down a little bit since January, like I said, down about 50 basis points, but I don't think we've gotten the relief that they need to see. What's interesting, and we heard this from Lennar last week, is that they're having more trouble qualifying buyers. So maybe people have the down payment and they could afford a monthly payment, but their overall debt levels, just because of everything else that they're having to deal with, the cumulative impact of inflation, is getting it a little more challenging for them to qualify.
So we heard from KB Home. They reported today, I see the stock down 5% at a 52-week low. They also, I guess, called out home affordability. What's going on at KB?
Yeah, so sentiment coming into the quarter was already pretty low across the space, and they fell short of those expectations. Orders were down 17%. They had guided to orders being about flat, so a pretty significant miss on the order front. So they also cut their revenue guidance and their margin guidance. And the reason is, and this is something we're seeing across the space, more incentives, but they're doing it on the home price front. So they're reducing base home prices, which has been less common so far in the industry. They've cut prices in about 50% of their markets by an average of $15,000. They said that ranges anywhere from $5,000 to $30,000. And what's interesting is they mentioned that they're having to get more aggressive in markets in Florida, which is something we heard from Lennar as well.
That's really interesting. Also, quite a big number. When you mentioned that the worry about higher rates, right? And everyone was kind of expecting lower rates this year or the end of last year and it didn't materialize. If we just sort of normalize around these levels, what's the lead time until consumers say, "Oh, okay, I can be okay with 7%"?
Yeah, I don't know how comfortable people are going to be with the 7% mortgage rate. I think you need to see maybe something in the low sixes. We've heard in the past that anything with a 5 handle from the builders has done well, but I think maybe the way forward might be, at least for the builders, is on home prices. Prices are, like I said, 50% above pre-pandemic levels, and I think people are just having a lot of problem with that. Maybe there's a little bit of fear of buying at the top of the market that's holding them back. So again, it goes to not only the confidence issue from the economy, but how confident are they in the sustainability of these elevated home prices. So rates are certainly a big component. As rates come down, you'll see that marginal home buyer come back in, but I don't think that's the only factor that's holding things back.
All right, Drew, thanks so much for joining us. Drew Redding, homebuilding analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
With Alix Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcasts Live, and that's where you'll find us here. Looks like the markets have kind of stabilized here. We had that peak to trough pullback of about 10%, and we've kind of been bumping along rallying a little bit, 2 or 3% off of that bottom here. Let's check out where we go from here. Grace Lee, Senior Portfolio Manager, Columbia Threadneedle, up in Boston, joining us via that Zoom thing. So, Grace, again, peak to trough on the S&P 500 just a few days ago. We'd kind of hit that 10% correction level. We bounced a little bit here. How do you think about the market these days?
Well, I think the market did have a healthy pullback. It was probably necessary after a couple really strong years, and it's probably warranted given all of the uncertainty, particularly with the Trump administration coming in, not even 100 days in, and all of these changes and executive orders and tariff threats, and then pullbacks on tariff threats. So this is all, I think, just part of a healthy digestion process. And I think it also might be heralding, a shift in where investors might be looking for the next opportunities after, a huge run in particularly growth stocks. Which
begs the very unsophisticated question, is it a sell the rally or buy the dip scenario?
Well, I think it might be a little bit more nuanced than that. It might be more of a rotation by the dip in other sectors, in other companies that investors may not have looked at previously. It's not necessarily going back to the same things that have worked in the past. I do think the market deserves to broaden out and is broadening out, and I think you can see that already year to date in the bifurcation between, let's say, value and growth stocks. Value investors like myself actually think things are looking okay and feeling pretty decent in the market. I think my growth peers maybe not so much. But I think that, again, I think investors have maybe lost a little bit of their muscle memory in looking at things that are not growth and momentum and tech. And so I think, aside from selling the rally or rotating into the same old things, it's really, rotating into other things that have not worked as well and are looking extremely inexpensive and actually attractive right now.
Value versus growth. Where do you see the opportunities here? This has been a market that's been driven by tech and the Mag 7 for a long time. How do you see it going forward?
Yeah, I think I think this might be the year for value stocks. It is starting out that way, and I'm pretty optimistic about that. I think that the setup is actually very good for value stocks in that you have had a couple years of very strong growth-driven markets. And I think you're starting to see a little bit more hesitation on even things like the AI trade. And so for investors that want to hedge a little bit, take some chips off the table, not necessarily put it all in European stocks, there's ordinary American stocks. I think people talk about, is American exceptionalism over because of, let's say, DeepSeek?
Yeah.
I would say that, I think if they refocus on the American ordinariness, the core companies that make up the base of the economy, the bread and butter, and this largely pertains to traditional value stocks, and these are the companies that put up reliable singles and doubles. They're usually not going to hit it out of the park, but I think that's the area that, again, is starting to perk up this year and probably has some runway here.
So that whole idea, Grace, the TINA, there is no alternative. That's why you have to buy U.S. stocks. It feels like TINA doesn't exist anymore, but that doesn't necessarily mean sell U.S. stocks.
Right. It's just looking at, again, the ignored sectors of the market. If you could believe that the energy sector is up, I think, close to 8% year to date, and that's even with knowing that OPEC Plus might have a lot more oil coming on the market. So there's a lot of areas that have been really ignored by a lot of investors who have really crowded into the growth tech space for such a long time. And, and I think it's looking at value stocks as not just a, run for shelter, but also just a good place to find, interesting companies and sectors that are going to work in a moderating growth economy, which I think is what we're going to be seeing, not necessarily recession, although if we do go into recession, again, a lot of these value and defensive stocks will work better as well.
Right. All right, Grace, thank you so much. Always appreciate getting a few minutes of your time. Grace Lee, Senior Portfolio Manager at Columbia Threadneedle.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Boy, I think we've gone several days without really talking technology. That's not like us.
It's been like a full 24 hours, but yeah.
Okay.
Yeah, well, we're counting weekend, it's like 72.
Exactly. Mandeep Singh joins us. He'll fix that right away. He's a senior tech analyst for Bloomberg Intelligence. All right, kind of the news that got our attention a little bit is Bloomberg News reporting tech chiefs, foreign leaders urge President Trump to rethink AI chip curbs. What is the current understanding of how tariffs may impact the global chip market? Boy, because when I think about a global supply chain, chips is certainly right there.
Absolutely. And look, I think the earliest export controls go back to 2022 when the Biden administration imposed controls on NVIDIA kind of shipping their highest end chip to China. So at that time, it was really restricting their interconnect bandwidth because remember, with AI, all these chips are used as a big cluster. So they thought that could prevent, China from using the latest NVIDIA chips. That didn't suffice. So then they added kind of a new form of restriction, and then the diffusion rule came into play, which was almost 168-page rule around like how NVIDIA is supposed to ship their latest and greatest chips to 3 different sets of allies in terms of, countries that have unrestricted access versus the ones where China could use them as a proxy to get access to the chips. So there were different sort of clauses in terms of restricting the access to those chips. But at this point, given we keep hearing about Chinese LLMs, Ant Group being the latest one, releasing their own LLM at low cost, it just goes to show that even with all the restrictions, it hasn't really impeded their progress in any way. And they're able to, build on whatever they have available.
So to that point, did chip companies then are like, hey, just let us get a piece of the pie that's already going to build no matter what? Or are they really losing revenue from this?
Yeah, so there are 2 sides to it. One is if you ask an LLM company like OpenAI, Sam Altman has said, had it not been the export controls, they would be more undersupplied. Remember, this market has been undersupplied for a very long time. Everyone wants more GPUs that they don't have access to. If the export controls were not in place, these companies would be even more undersupplied. But the other side is NVIDIA is saying, I'm losing revenue because I have got 20% revenue exposure to China. It's getting lower and lower to the point that it will be less than 10% now. And I'm losing potential revenue that I could get by selling my chips. So there are both sides to it. But I think the fact that this market is undersupplied means that NVIDIA does have somebody to buy their chips, and they continue to command premium pricing for that.
Do we have any idea where China is in terms of developing their chips, where their technology is?
Yeah, so with the latest Ant Group model release, what they said was they were able to bring down the pre-training cost by 20% by using not just the chips that are available from NVIDIA, but also their homegrown Huawei chips or, AMD chips. So they talked about a heterogeneous compute architecture and using that for pre-training. And look, in the end, everyone is looking to optimize the infrastructure, more so in the case of Chinese LLMs, because they don't have access to the latest NVIDIA chips, which give you more performance per unit of power than any other chip company can provide. So from that perspective, I feel they've done well in terms of using what's available. But clearly, I think the US-based LLM companies have an advantage given they have the best performing chips and they can train their models much better. They can use it for reasoning. So it is an advantage at the end of the day.
That's why I was asking for Ant and DeepSeek, et cetera. Like, are they accurate in the same way that LLM models in the US are accurate?
No, I think the OpenAI models are way better when it comes to the reasoning capabilities and really the multimodal capabilities that everyone cares about. At the end of the day, the use case for AI is not just a text-based prompt response. It's much more than that. If you're talking about AGI, and everyone feels like we can get to AGI, it's not just text-based. You need audio, you need video, and the Chinese LLMs are still way behind when it comes to the other modalities.
All right, let's be honest. You and Anurag built a career on 7 stocks, basically. Do people still want to talk to you about the Mag 7, or is that just passe?
Absolutely. I mean, you can't really talk about the indices without these Mag 7 stocks. So no matter what happens to the market, these are some of the best companies when it comes to generating free cash flow. And look, they have tremendous moats. So and they drive the market.
Do investors feel like that, 15% or so drawdown in the Mag 7s, is that temporary? Are there still, that hasn't knocked anybody's confidence in those names?
Yeah, it's still the prevailing sort of sentiment that, you buy the dips on these companies because they just are fantastic when it comes to generating free cash flow.
Well, what I keep hearing a little bit, though, too, is that where these things are built, like the data centers and how you power them, that's now kind of up for grabs. Like, we know that they're going to work, obviously, in, like, Virginia, but are they really going to work in Texas? And are they really going to work in, like, North Dakota? And are they really going to work with all this energy? So it's like how you get it done feels like a question, but that shouldn't affect the actual CapEx spend or the demand. That's just sort of the back end part. Anyway.
Yeah, that's the first and second derivative play that everyone keeps talking about.
Yeah, and that seems to be where the question marks are. Mandeep, always a pleasure. Mandeep Singh, Bloomberg Intelligence, Senior Tech Industry Analyst. And I should point out that spokespeople for the White House and Commerce Department did not respond to requests for comment on the story of tech chiefs and foreign leaders urging Trump to rethink some AI chip curbs.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.